Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association. Statements may reflect the opinions, estimates, and current projections of Aegon USA Investment Management LLC as of today and are subject to change. Such statements are intended for airing exclusively by the sponsor to invited participants on this call. The discussion includes no recommendation to buy, sell, or hold any specific security and should not be considered as constituting investment advice. Past performance is no guarantee of future results.
This is Conversations, the official MTA podcast series, and today's guest is Sridip, Mukhopadhyaya of Aegon USA Investment Management. Sridip is a CFA, CPA, CMA, and FRM. Sridip joined Aegon in 2007. Sridip is a portfolio manager for AUIM's quantitative strategies. His primary responsibilities involve managing and developing quantitative portfolio strategies that provide solutions for specific investment objectives. Since 2008, Sridip has been involved with the portfolio management and special initiatives teams to develop various retail portfolio strategies. His responsibilities also include quantitative and risk analysis for fixed income desk and trading ETFs for various strategies. Welcome to the program, Sridip.
Thanks, Lance. Thanks for having me.
You bet. Now, I want to start with a fun piece of information. As I understand it, you are a new father.
That is very true. It's a little girl that just turned 3 months.
3 months old. So, did you attend the MTA symposium this spring?
Indeed, I did.
So you had a newborn, and you must have had a very understanding wife to let you attend the MTA symposium.
Yeah, I had to. I told her it was extremely important and that I had to go because I needed to sleep.
Well, I think the MTA owes you a free T-shirt or something. We should talk to Dave Keller about that and see what we can do. Well, let's start with your background. Where do you come from? What attracted you to the financial markets?
Well, I come originally from India. I started my career in public accounting working for Deloitte & Touche in India, but then I slowly realized that my interests were more aligned with investments in finance, and so I took that and then got my MBA in finance from the University of Iowa. And then, moved on, got certain important credentials, certifications that the market likes to see, and that employers like to see. And here I am.
Excellent. Yeah, I'd say the credentials you have, we're running out of space. I don't even, what is, so you have your Chartered Financial Analyst, your Certified Public Accountant, a CMA, what is that?
Certified Management Accountant.
Certified Management Accountant, and an FRM is a Financial
Risk Manager.
Risk Manager. Okay.
So,
and rumor has it that you did your CFA and your CPA concurrently. Is that true?
That
and
is true,
FRM.
yeah.
That is amazing. That is amazing.
Well, I must admit that I do have my chartered accountancy from India, and to be quite honest, it's a much more difficult certification than the CPA in the U.S. So I think I had an advantage there.
Okay. Now let's move on to your time at Aegon. In recent years, billions of dollars have flowed into the quantitative models that you've created. And the things you've created range from index funds to strategic funds. And I want to focus on the more strategic funds that you've done. And one recent one that you've rolled out is the Transamerica Tactical Income Fund. And I know that has a lot of inputs ranging from fundamental to technical. Can you tell me what the central logic is behind the Transamerica Tactical Income Fund? And the ticker on that is IGTAX.
That's correct. Yes, and just as an introduction, the central logic behind all of the tactical funds that we manage is similar. So the underlying chassis or the engine is pretty similar. So what I say now would be applicable to any of the other tactical funds that we have. So,
Okay.
in a nutshell, the logic behind the quant model is the concept of systems analysis. So basically using technical analysis of economic data to predict medium or short-term market movements. So in our view at AUIM, we believe that prices, interest rates, and the like are merely symptoms. They're the outward manifestation of an underlying economic activity. So for example, price of a commodity, let's say oil or gold or something, may rise because the economy is getting stronger or because a major supplier, let's say Iran, is hit by an earthquake or has a war going on, or the Middle East uprisings that we have seen. So the symptom, which is the price increase, can be the same, but the underlying reasons can be different. And what we have seen is that the difference in the underlying reason can change the period and the amplitude of the resulting cycle. So what we like to do is to try to look at the underlying indicators, the economic indicators, perform technical analysis on them, and use that for predicting short-term market movements. So
Now, how many indicators are we talking here? How big is this model that you're managing these indicators?
So this particular model has about 40 different indicators.
Wow.
But having said that, I think it's important to understand that it's not one. The 40 indicators don't lead to one decision. There are several tiers of decision making going on within the model. The first tier, the highest tier, is that of deciding between risk on and risk off, or deciding how much we want to have in equity type asset classes versus fixed income type asset classes. But then as you drill down, there are several layers. For example, in equities, what regions do you want to be invested in? In fixed income, what duration band do you want to be invested in? Do you want more credit? Do you want more treasuries? What kind of risk do you want to take? So the 40 indicators are not all trying to do just one thing. There's many different decisions that are going on.
Sure. Okay. How did this model evolve? Why did your firm decide to launch this particular fund?
So, our foray into this kind of tactical quantitative models came back in 2009 when our variable annuity hedging team approached us to see if we could construct a more well-behaved portfolio from a hedging standpoint. So by well-behaved, basically what they wanted to see was that the volatility was controlled and that the overall risk standard deviation of the portfolio was within certain tolerable levels. So they approached us and we built this suite of tactical VA funds, variable annuity funds, that would respond to various economic indicators to maintain the realized volatility of the fund within the acceptable levels that they had provided us. So the success of those strategies was recognized, and the firm decided to leverage that to meet other investment objectives. So in this low-rate environment, income is in very high demand. You are hardly getting anything from treasuries and high-quality bonds. So our affiliate, Transamerica Capital Management, approached us to see if we could build a strategy that would provide regular income at a decent level, say about 5% on average, and also provide lower volatility and downside protection, the same kind of well-behaved characteristics that we had provided for the VA funds. So that's basically how this idea came about.
And how do you accomplish that? How do you get this low standard deviation in this fund?
So we call this basically managing economic downside risk or economic tail events. And it's managed by having wide tactical bands that allow us to dial risk up or down based on the model's assessment of risk. We generally segregate our portfolios into two sleeves. a higher risk sleeve, which has asset classes that have higher correlation to equities. And then, so basically that would include asset classes like high yield, preferred stock, REITs, so on. Of course, equities. The second sleeve is a lower risk sleeve with asset classes like investment grade corporates, treasuries, TIPS, and so on. So we have the ability to move 40% in a range of 40% to overweight or underweight the higher risk portfolio versus the higher risk sleeve versus the lower risk sleeve. That's basically how we manage the downside risk. So anytime the model indicates that the equity risk in the markets are high, we will go ahead and reduce. The model automatically is calibrated in a way that it will go ahead and reduce the allocation to the higher risk sleeve.
So there's a relative strength component allocating to strong sectors and underweighting to weak sectors, but you're also using volatility measures as well?
Yes, volatility is a key indicator, as you would imagine. So we perform various kind of moving averages and technical analysis trying to identify trends and volatilities. We'll also do that for the VVIX, which is the volatility of the VIX. So we are using different metrics to decide on not just what kind of allocation we want to have to this higher risk sleeve versus the lower risk sleeve, but also within the higher risk sleeve, which regions do we want to be in? Do we want to be in international? Do we want to be in Europe or emerging markets, the U.S.? Which areas do we want to be in? Is it better to be in REITs versus equities or high yield? Which is the better asset class? So vol plays a key role in determining a lot of those things. And in every case, we are looking at volatilities for each of those specific asset classes or regions.
So what would you say the weaknesses of this model would be?
Well, I think the biggest weakness of all quant models is irrelevance. The model is dependent on the assumption that the combination of trends in certain economic variables can predict certain market outcomes. And that assumption may be rendered incorrect by market changes. So, if you just think about it, new financial instruments, high-frequency trading, globalization, there are so many reasons why trading 10 years back is not the same as what it is today. And so the same issue or the same thing can happen again, and it will happen again. And so we have to ensure that the models remain relevant and valid. And we try to achieve that by reviewing the assumptions annually. So if you think about it, that is what my job is. I don't manage seriously, I don't really manage the trades on a day-to-day basis or the allocations on a weekly basis. That's all handled by the model. It's totally unemotional. I don't even have override powers. But my job is to make sure that the models are right, the assumptions are still valid. So we'll constantly look for new indicators, test them, and see if we get a better outcome. And of course, annually we'll test all the indicators that are in the model to see if the level of accuracy that we were getting in the predictions is still true. So that's pretty much what I try to do.
Okay. You can hardly turn the news on today without hearing about a doomsday scenario in the U.S. or recently it's been Europe. What kind of economic scenarios concern you?
It's funny. It depends on the fund's objective, really. If you're talking about the Transamerica Tactical Income Fund, the goal of that fund is income generation. So we are really constrained in certain ways to make sure that we are always invested in asset classes that provide a certain level of income. And what that can result in is basically a scenario where we are forced to hold something like high yield, even when that might not be the best choice. Simply because our investment target objective is to provide that kind of a 5%-ish yield. For me, the scenario that I fear most for this particular fund is basically stagflation, where we have runaway inflation with little or no growth. And because what that will do to the fund is basically it will push it to a very conservative allocation because the economy is not growing. That's how the model is calibrated. But at the same time, there'll be runaway inflation, and because we cannot hold commodities in this portfolio, we'll not be able to provide much of a protection against that either. So hopefully we don't get into a stagflationary scenario, but if we do, then this fund might not be the best one.
Well, how likely do you think that scenario is?
Well, right now, I don't see it coming anytime soon because, while money supply is at its highest, velocity of money is really, really low. And again, we have seen the slowing, the weakening in the job markets again, and with, the housing market being down and very low probability of labor cost inflation, I don't see actual CPI inflation being high anytime soon. But the fact is that it will come. It's only a matter of time. It will come, and hopefully what we don't have is a weak economy at the time it does come back. So inflation will hit us, interest rates will go up, but that will probably not happen in the next 2 or 3 years, and maybe by then things change and the economy gets better.
How can we learn more about your funds?
Well, there's marketing materials that are available on the website, so you can certainly go to the Transamerica website and look at the marketing materials. That's probably the best way to learn about this. And of course, the funds are on Bloomberg and on Morningstar, so you can get quite a bit of information just by looking at those vendors as well.
Okay. Is there anything you'd like to add before we go?
Oh, thanks. This has been a great opportunity. Thanks for having me.
Absolutely. Thank you for your time. Today's guest has been Sridip Mukhopadhyaya, and that concludes today's MTA podcast. From Lexington Capital, LLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarek at the MTA, reminding you that price is always right.